Hey everyone, Disney's stock price is trading at $81.58 as of this recording, and this is lower than the stock price has been going back almost all the way to 2014, if you could see here on this chart. So that has a lot of investors asking what's going on with Disney stock. So understandably so. And in this video, I'll go through briefly providing an overview on why Disney stock is down so much. Starting with, I have the chart up here, earnings per share over the trailing 12 months. Look at this chart up here. You could see going back 2014 until 2019, Disney's earnings per share was steadily climbing from $4 earnings per share all the way up over $8 earnings per share. But then, as a result of the pandemic, its earnings per share absolutely crashed, hitting close to negative $4 per share as it had to close down its theme parks and invest aggressively in rolling out its streaming services. Now, since then, since economies have reopened, Disney's earnings per share has been rebounding all the way up to $1.23, but that's done little to assuage investors who are still selling the stock and the stock price is still down. So let's look deeper into the company and what's been happening and the big overall theme here. And CEO Bob Iger came back to the company after the previous CEO was removed, and Iger was asked to come back to try and right the ship here. And one of the first major things he was doing is major cost cuts. So they're on track to exceed their initial goal of $5.5 billion in savings. So one way to boost your earnings per share is to lower cost and find efficiencies, and this is certainly going to help. Another thing they've been doing is right sizing the streaming service. So the direct to consumer, which is its streaming service, operating income improved by over 1 billion in just 3 quarters, and they continue to work towards achieving direct to consumer profitability by the end of fiscal year 2024. So that's going to help boost earnings per share as well. So the CEO is saying that there's going to be 3 parts of its business that's going to drive growth and value creation over the next 5 years. And those 3 parts are its film studios, its parks business, and streaming segment. Those are the 3 areas the company is going to focus on to drive value and to drive growth. And what you'll notice there, what's missing is the linear business, the cable business. That's been in secular decline for several years now, and that's going to continue in that direction. And Disney is just saying this is inevitable. This is a matter of when, not if, their business completely shifts over to completely streaming. So that's what they're in the transition of, and this transition has been messy. It's been hurting its earnings per share as it's transferring over to a different consumption model. The legacy model, where people watch their content through cable services, cable connections, or satellite TV, was very lucrative and profitable for Disney. And this new model, the streaming model, might be lucrative and it might be profitable more so than the previous model, but that remains to be seen. That's a risk. And that risk, that uncertainty, is what has investors concerned. Investors liked the previous model. It was predictable, it was profitable, they liked it. And now that they're switching to this new model, there's a lot of question marks. Investors don't like question marks. They don't like uncertainty. That just means risks. And so that's why Disney stock price is seeing such low levels, is because of that risk, because of that uncertainty. And until Disney can prove, and the industry for that matter can prove, that it can operate the streaming industry, at at relatively high profit margins, it's gonna constrain Disney stock. And so the company's gonna focus on improving the quality of their films, on better economics, and not just reducing the number of titles, but also reducing the cost per title. So essentially, Disney is a content business at the core. Even the theme parks rely on the content side of the business, as popular characters are turned into featured attractions at the theme parks. So it's really the content, the studios that fuel the rest of the business. And so they're going to focus on this area, try and make higher quality films, better economics, and not just reducing the number of titles, but also the cost per title. So that's pretty much what's been going on with Disney. And it's a process, it's going to take time. Disney's not going to turn things around next quarter, next week. It's going to take time for this transition to play out. And so I don't suspect the stock price to experience a big jump anytime soon. But over the long term, I think Disney stock offers investors a good risk versus reward. But that's all I've got for this video. Thank you for watching. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.